The year 2008 marked a seismic shift in global finance. What began as a subprime mortgage problem snowballed into a full-blown financial crisis, shaking the foundations of international economies. At its core were complex financial instruments that few could claim to understand. This was not just a crisis of numbers and markets, it was a crisis of faith in the system. As banks crumbled and savings were wiped out, the world watched in horror, wondering how it all came to be. In The Big Short, Michael Lewis does more than just recount events. He paints a vivid picture of the personalities and mechanisms that played a pivotal role in the financial meltdown. Through his narrative, we gain insights into the toxic mix of ignorance, arrogance, and greed that led to disaster. The Big Short isn't just a tale of economic theories, it's a story about people. Michael Burry, an eccentric hedge fund manager with a penchant for heavy metal music, was among the first to predict the crash. Steve Eisman, a blunt-speaking fund manager, saw through the facade of the mortgage lending industry. Each of these characters brought a unique perspective to the looming crisis, driven by different motives but united by their disbelief at the market's blindness. Their stories are not just instructive, they're profoundly human. Understanding these key players helps us grasp the complexity of the financial systems and the personal stakes involved. As we explore their decisions and actions, we see a reflection of the broader market forces at play. The economy seemed invincible in the early 2000s, with homeownership booming and credit flowing freely. However, beneath this prosperity lay a ticking time bomb, the housing market bubble, fueled by subprime mortgages. Lenders handed out loans to unqualified borrowers, often with little regard for their ability to pay back. As these risky mortgages were bundled into securities and sold globally, the financial system became increasingly vulnerable. The assumption was that housing prices would continue to rise, but this was a dangerous gamble that soon proved catastrophic. Michael Lewis deftly explains this buildup, showing how greed and optimism blinded experts and novices alike. The impending disaster was not just a failure of financial instruments, but also a human failure of recognizing risk. Credit default swaps, CDS, and collateralized debt obligations, CDOs, are two financial instruments that played starring roles in the financial crisis. CDS are essentially insurance policies on bonds. If the bond defaults, the issuer of the CDS pays the holder. CDOs, on the other hand, are a type of structured asset-backed security whose value and payments are derived from a portfolio of fixed-income underlying assets. These instruments were designed to spread and manage risk, but instead, they magnified it. As Lewis outlines, their complexity and opacity created a false sense of security among investors and institutions. The misuse of these tools turned them into financial weapons of mass destruction, as Warren Buffett would famously describe. Understanding these instruments is crucial to understanding the crisis itself. They are the threads that, when pulled, unravel the whole fabric of the financial system. Against a backdrop of widespread financial euphoria, a few astute observers sensed impending doom. Michael Burry, for instance, scrutinized the underlying loans of mortgage bonds and detected their instability. Recognizing the opportunity, he approached several major banks to create and then bet against credit default swaps tied to these shaky bonds. Similarly, Steve Eisman and his team, through diligent research and somewhat disbelief at what they uncovered, decided to short the housing market. These bets were not mere gambles, they were informed predictions based on thorough analysis and a deep understanding of market mechanics. Lewis uses these narratives to dramatize a fundamental truth about markets. They are driven by perceptions as much as they are by economic realities. The foresight of these individuals resulted in colossal profits, but also highlighted a massive systemic failure. When the bubble burst, it wasn't just the little-known financial instruments that collapsed. Major institutions like Lehman Brothers and Bear Stearns found themselves on the brink of disaster. The fallout was rapid and merciless, with Lehman Brothers filing for bankruptcy in 2008, an event that shook the global financial markets to their core. The government scrambled to respond, resulting in controversial bailouts and unprecedented interventions in the financial sector. These actions sparked a debate that continues to this day about moral hazard and the appropriateness of rescuing failing financial institutions. Through Lewis's narrative, we witness the domino effect of the crisis, how it escalated, and how deeply it affected everything from small homeowners to giant banks. The dust eventually settled, but the landscape of finance and its regulation had changed irrevocably. The crisis led to significant reforms, like the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States, aimed at preventing such disasters in the future. Yet, as Lewis points out, the real lessons go beyond regulatory measures. They touch on the essence of risk, the importance of transparency, and the eternal tension between innovation and regulation in finance. The crisis also served as a harsh reminder of the interconnectedness of global financial systems and the potential for contagion. Reflecting on these lessons helps us understand not just past mistakes, but also how to better prepare for future financial storms. The financial crisis was not just a failure of systems, but of ethics. Michael Lewis delves into the moral ambiguities faced by the protagonists of The Big Short. These individuals profited enormously from the collapse, a fact that raises uncomfortable questions. Can one ethically profit from others' misfortune? Moreover, the broader financial industry faced criticism for its role in exacerbating the crisis. The aggressive marketing of subprime mortgages to vulnerable consumers, the opaque nature of CDOs, and the conflicted roles of financial institutions that both advised and bet against their clients all highlighted deep ethical flaws. This section sheds light on the ethical quandaries and the need for a moral reconsideration in the finance sector, suggesting that financial acumen should be coupled with ethical responsibility. The media played a crucial role in both inflating the housing bubble and in its aftermath, shaping public perception of the crisis. Initially, the relentless promotion of the American dream of home ownership and the underreporting of risky financial practices contributed to the bubble. Post-crisis, the media narrative shifted to one of outrage and demand for accountability. Lewis critiques the media's role, highlighting the lack of critical financial journalism in the run-up to the crisis and the sensationalism that followed. This part explores how media shapes financial trends and public opinion, potentially leading to market distortions. The Big Short provides a unique lens to view the 2008 crisis, but it wasn't the first of its kind. This section compares it to past financial crises, such as the Great Depression of 1929 and the dot-com bubble of the late 1990s. Each crisis has its unique causes and effects, yet common themes of speculative bubbles and regulatory failures emerge. By examining these patterns, we can better understand the cyclical nature of financial crises and the enduring lessons they offer. Lewis uses these historical parallels to underscore that while the actors and assets may change, the underlying human behaviors of greed and fear remain constant. The 2008 financial crisis left an indelible mark on culture, influencing everything from cinema to literature. Films like The Big Short and books like Lewis's own work have helped democratize complex financial concepts, making them accessible and engaging. This section discusses how the crisis has permeated popular culture, shaping how people understand and discuss financial systems. It also considers the role of such cultural products in educating the public and potentially influencing policy and personal financial decisions. Throughout The Big Short, various economic theories are employed to explain aspects of the crisis. This includes discussions on market efficiency, behavioral finance, and the role of incentives in financial markets. Lewis does not just describe these theories, he tests them against the real-life experiment of the crisis. This part breaks down these theories and evaluates their relevance and application in understanding the events of 2008, providing a deeper academic layer to the narrative. The epilogue of sorts, this section catches up with the key figures from The Big Short. Where are they now? What lessons have they taken from their experiences? Many have continued in finance, some have turned to philanthropy, and others have retreated from the public eye. Their journeys provide a human closure to the saga of the financial crisis, reflecting on the personal and professional impacts of their decisions during and after the crisis. As we conclude our exploration of The Big Short, we reflect on the key lessons about financial wisdom, ethical considerations, and the societal impacts of economic phenomena. Looking forward, we consider the future of financial markets in an increasingly interconnected world. Michael Lewis's narrative is not just a history lesson, it is a call to vigilance and wisdom in financial matters, a reminder of the past that should guide our future. This final section synthesizes the insights from the book, emphasizing the ongoing relevance of its lessons in today's financial landscape. Key takeaways. 1. Understand the risks involved in financial markets. Navigating the financial markets requires an awareness of the inherent risks. From the housing market collapse to the subsequent economic fallout, The Big Short highlights the importance of recognizing and preparing for potential downturns. 2. Diversify your investments. A key lesson from the crisis is the importance of diversification. By spreading investments across various assets, the impact of a single market's decline can be mitigated, providing a buffer against economic turbulence. 1. Stay informed about market trends. Staying abreast of market trends and developments is crucial. The protagonists of The Big Short were able to foresee the crisis by staying informed and questioning prevailing market assumptions. Knowledge is a powerful tool in financial decision-making. 1. Learn from past financial crises. History has a way of repeating itself. By studying past financial crises, investors and policymakers can identify patterns and warning signs, making it possible to prevent similar occurrences in the future. 1. Ethical considerations are crucial in financial decisions. Finally, ethics play a vital role in finance. The Big Short underscores the consequences of unethical behavior and the importance of integrity. Ethical decision-making not only fosters trust, but also contributes to the stability and sustainability of financial systems. These takeaways serve as guiding principles for anyone navigating the complex world of finance. By understanding risks, diversifying investments, staying informed, learning from history, and prioritizing ethics, we can build a more resilient and responsible financial future. Thank you for joining us on this journey through The Big Short. Stay vigilant, stay informed, and always prioritize ethical considerations in your financial decisions. Until next time, stay curious.